kind of jump on to understanding what is investing in itself, and or what is investment, right? That's the basic essence of what we're going to learn now. So now, what is this investing? If I have to ask you, what is investing, what does occur, what thoughts occur to you in your mind? Just go to the comments and then put in whatever comments, whatever thoughts kind of come in. From your point of view, what does it mean? While you kind of get your thoughts, let me kind of share with you the dictionary meaning of investing. Investing, as per the dictionary, if you open up any dictionary and look it up, it says that it is simply to put the money into a bank or a business or a property, in similar kind of ventures, in the hope that you will make a profit out of that. You put it there and in the hope that you will make a profit. That is one definition. And the other definition, which is interesting, is it also says to spend money, time, and energy on something that you think is good or useful. That is also investment. So now it's very important that you understand both these dimensions when it comes to approaching the market on investment. Now why? Why is that you have to understand both, and why not just the first one? Most of us will look at it, put the money into some kind of instrument and then expect the return, and that's all it is, right? While that is true, but the second definition is very important, and in that, the third aspect, which is energy. It says to spend time, money, or energy. I would say instead of or, I would put in and energy. Now, wherever you put in your energy, wherever you invest your energy, you will start to see a benefit coming out of that from that direction. So anything and everything in your lives, right? Wherever you put in your energy, that's where you start to see the returns coming in. So, and that is called as true energy, or a true investment. So now, because of which it is of paramount importance that you also think about investing on yourself. So if you are going to get into the stock market, either through investing or trading, invest in yourself first, learn that, go deeply and assimilate that, because that ROI, what you will give yourself, will be the highest than anything else. So that is what investing as a definition means. Now, let us kind of really go deeply and understand what is this investing or investment when it comes to capital markets, right? And that's what we are kind of in. So there are various instruments you can kind of really invest in. So the definition said investing in a property or investing in a bank. So you can kind of, or etc. You can change either the bank or property and include that as capital. Replace that by capital markets and you will start to see various instruments. Now let us go instrument after instrument based on the risk profile. And I have started with those which have the lowest risk and then gradually moved on to slightly high risk instruments. So this will kind of take some time. So be prepared to kind of make notes and take down everything, right? So now the first one here is very safe, which is the government securities, right? If you want to have your money absolutely safe, the safest is the government securities. Now what is this government securities? Government securities are those instruments where government of a state or a country stands guarantee to return back the money which somebody has put in, along with some kind of interest, along with some kind of earnings. Government stands. Whatever happens to the project, it does not matter, but the government stands guarantee to give it back. So once the government stands guarantee, those instruments are the highest when it comes to safety. So within this there are two kinds of securities. The first one is the government bonds. This is a very, very common one. So what are these government bonds? These are one of the most safest one, and almost they have almost zero risk because of the government involvement here. Now, what are these bonds? Bonds are instruments through which government raises capital, raises money from the public to implement a project. It could be something like a infrastructure project, or it could be something like a developmental project. So whatever the projects which government does, so for that it raises capital by issuing these bonds. So people can kind of go and invest in these bonds, like infrastructure bonds or developmental bonds, or various these kinds of bonds. There are various bonds which you can kind of go, just kind of, if you kind of go to your broker and kind of look for investing in bonds, all of that kind of comes up. This happens both by central government and state government. You can choose whether you want to kind of invest in state government bonds or central government bonds. Both are kind of equally safe based on the returns. Almost both of them have the same returns, no big difference. So you can kind of invest that. So that is the first one. Which one? One is the important thing here to understand is they have a fixed period of maturity. It's not like you invest in a bond and then you can kind of just get out of it. No, they have a fixed period, say like 2 years, 3 years, 4 years, 5 years, based on that. So that is how the whole period of the bonds is. So you pay a certain entry level for that, say 5,000, 10,000, 20,000, 50,000. There is going to be a certain entry level and then multiples of that. So once you kind of pay that, once you kind of invest that gets locked in for a certain period of time, and then at the end of it, along with the maturity, when it gets matured, with the interest you get it back. So like any other securities. So that's one. Now, good thing about these bonds are, while they have a fixed maturity period, these are traded in the market. And you can exit by selling these in the markets. So if you say there is a 3-year bonds or a 3 years lock-in or a 5 years lock-in, whatever, you get into a bond. But now, since they're also traded, if you have any need of the money, so based on you won't get it as much as what it will fetch at the time of retirement. So based on what it's currently trading at, you can kind of sell those in the open market and get your money back. So that's an advantage in government bonds. So that's the first way of investing. The second is called as T-bills. Now, what are these T-bills? T-bill stands for treasury bills. These are also government securities issued by state government or the central governments. The only difference is that these T-bills are issued with maturity of less than 1 year. It's fixed. They have some capital requirement for some project for like next 6 months or 8 months or 7 months or whatever that is. So they kind of do that. So you can kind of, where you want the returns back for a shorter period of time, you can go for T-bills. Now, one's not so advantage thing about T-bills is, once you enter, since it is less than 1 year, these are typically not traded in the stock market, and you have to wait until the maturity period, until the maturity period comes in, until the duration is over, the tenure is over. So T-bills you have to get in only if you are sure that for the next 6 months, 1 year, whatever is the duration of that maturity period of the T-bill, that you do not need that money for anything else. That's when you go for T-bills. Otherwise, you go for government bonds, which have a longer duration, but you have the opportunity to exit. So based on that, you can kind of actually split your money, some of them in T-bills, some of them in government bonds, so that one works for your liquidity, one works for a reasonably higher returns. So these are the first category, government securities. I hope you're kind of getting that notes. If you kind of got so far government securities, go to the comments and type in getting government securities or getting GS. Awesome. So now the next one is fixed deposits with bank and other financial institutions. This is a very, very common thing, right? Especially in India, if you go to my parents' time, this was one of their most favorite way of investment. Whatever additional money they had, they simply went on creating deposits after deposits after deposits, right? I'm sure you would have also kind of come across. This is one of the very, very common one which everybody does that. However, in today's world, the interest on these fixed deposits have gone so low, it is no longer attractive. There was time when banks would give us as high as 12% or even 13% interest per annum, but now we know it's come down to sub 7, maybe even 5-6% in some cases. And now we've also seen the private banks, the cooperative societies, and many of the other institutions which kind of come and allow this fixed deposits, right? So, but you got to be careful in kind of choosing the right financial institution, especially if it is something which is not regulated by RBI. You would not want to go, right? So be careful with the cooperative societies or the smaller sector banks, which is like the community banks, which are registered either as a Sahakar Sangh, those kinds of banks, or closely held private banks, and you would not want to kind of go, because we have seen a lot of banks when they take those deposits, but they don't kind of manage the money well, and then there has been a lot of challenges, and I'm sure you've gone through many such examples in the recent past in our country itself. So scheduled banks are the safest here, followed by private banks as well, because they are closely guarded by the RBI, but the rate of interest again is going to be lower. That's the second category. The third category is the corporate bonds. Now, what's the difference between the government bonds and the corporate bonds? Actually, there is very less difference. It's more or less same in terms of the way it is being structured. However, the corporate bonds are issued by private limited companies and public limited companies. Like, for example, RECL, right? Rural Electrification Corporation of India. So they issue, it's a private limited company. They issue bonds for funding their electrification projects, right? So that way there are many companies which issue bonds. They are also good. The rate of interest is slightly better than the government bonds. But now here, before you get in, you will have to study, one, the company. What is this company? Who is behind the company? Then third, what are the projects they are getting into? How long is that project? If they have done some previous projects, have those projects worked well, and have they returned the on maturity the bonds based on what they had committed, and how is it going? So you got to a little bit study on that. So and when you study that, and when you are good, when the organization is good and the projects are good, you can go with the corporate bonds as well. They are good. They are pretty good. Some of those corporate bonds are pretty good, especially the RECL ones, and even I think in BEL also had those kinds of bonds which was kind of issued, and they kind of keep constantly issuing. So again, go to your broker, and any of the brokers, they provide all of this information. You just have to talk to your broker wherever you are opening your account, or wherever you have your trading account. If you do not have a trading account or a demat account or an investment account or a trading account, do not worry. We're going to discuss that as well in detail, and you can choose to open in one of those brokers and then kind of pick up these investments as well. So that's the third category, which is the corporate bonds. Very, very attractive. Actually, though some of them are really good. The next is again one of the most common ones, which is the mutual funds. Right, and in today's world, we are seeing so much of promotions happening on the mutual funds, and many of them invest in mutual funds, because what mutual funds do, they collect money from various people, and based on certain norms, there is a fund manager who's appointed, and that fund manager in turn invests that money in various segments of the capital market. Some of them will be in the bonds, some of them will be in the stock market, some of them will be in exchange traded funds and various categories. So mostly in stock markets and mostly in equity, or some of them also put that in derivatives based on what is the norms. So these are huge funds runs into thousands of crores each of those funds, and it gets invested. Now, what is very important is you have to kind of again here study these mutual funds, understand their rating, understand what is their charge, and third, understand what has been their performance over the last few years, and how they are able to help the investors grow. Now, what is most important here is this mutual fund is not a short term. It's not even a medium term instrument. It's a long term instrument. So only if you have a horizon of 5 years and beyond, you have to get into mutual funds. If your horizon is less than that, then mutual funds is not a great idea, unless some of those funds really do good. Otherwise, if you have a 3-year view, and if you are kind of investing certain amount and you want something to be done out of the 3 years, so that's what you have done, there is a possibility that there can be a erosion of your capital in 3 years based on what is the sector of the fund, where is the fund kind of performing and how is it performing, right? And in mutual funds there are various categories: open-ended, closed-ended one, and then what component of is towards growth, what component of it is, when I say growth, what component of it is in equities, what component of it is in debt fund. So debt fund have lesser, it's got only a fixed kind of return. Equity has a higher ROI, but also it comes with a higher risk. So you have to study, where is this money getting invested? Where is your money getting invested in turn? And if you are comfortable with that, you can kind of go with mutual funds. So mutual funds is a very, very big market, very, very, very big market, and a lot of investment kind of happens. And the very common one is SIP. It's like monthly you kind of give a standing instruction, investment. It's a standard investment plan. Every month, 1,000 rupees or 5,000 rupees or 10,000 rupees, based on whatever capital you have in mind, you kind of constantly keep on doing it for X number of period. So it can go even up to 10 years, 15 years. There are people who kind of have been investing in mutual funds like this for last 10 years, 15 years, 20 years as well. That over that much of a period, it gives a very good return. But you have to have a very long-term horizon for mutual funds. That's the next category. Now, after this is debentures or the debt funds. I would call this as more of debt funds. So again, these are issued by companies where it is guaranteed in terms of the capital one. And then the returns are also slightly lesser because the capital is guaranteed. So here you don't have an opportunity for it to grow. It is fixed return. It's like you loan out your money to somebody. It's like you're giving a loan to somebody, and on that loan, when they utilize the loan, they pay you the interest. And that's exactly is what debentures are. So many companies issue debentures. So based on the nature of the company, if you don't want to take any risk on your investment, so go for debentures, where the interest is slightly better off when it comes to some of the bonds or even the fixed deposits, because that money is directly utilized by the company in their business. So they give you a slightly higher higher interest on that, and then at the same time, it is relatively secure. If the company goes bust, right, after having paid the governmental commitments, next in line for receiving is the vendors and the people who have loaned it. So debentures have a higher right than the equity shareholder. So you are slightly better off when it comes to the risk part of it. So that's the next category, which is also kind of good. Many of them kind of do that as well. You can kind of explore that. Next is a very popular one, which is called as the exchange traded funds, or it's also called as ETFs. Now, what are these ETFs? ETFs, how does it work is, so every stock exchange, they create a fund. How do they create that fund? They take basket of scripts, basket of instruments, some stocks, some other bonds and everything, they mix up and create one fund. Say it can be in sector, it can be sector based, like power sector or pharma sector or IT sector or metal sector, various sectors, whatever we have, or banking sector, and they kind of take those set of companies and pool that together, and then they allow that to be traded by common people like you and me, where you can buy and sell. So now when you buy that, whatever happens to those group of companies, it's a weighted average of all of that, and that weighted average gets published in terms of the price movement of these ETFs. So when you see it, for you, it will appear as one single instrument, but behind that, there will be basket of instruments. Together with that, this fund is created. This is a very good one. So, for example, we have one of the very commonly and highly traded is Nifty Bs. Nifty Bs. It's very good. You know, it's directly aligned to Nifty 50. Nifty 50. So these Nifty Bs, they are in line with Nifty index itself, right? So as the index moves, it kind of moves. Right, so this Nifty B started way back, I think in 2000, if I'm not wrong, maybe even much before that. So since then, at that point in time, the markets were just about around 2000 points. Today, I think even less than that. Today, in 2021, Nifty is crossed 15,500, now inching towards 16,000 and 18,000 levels. So you can only imagine in the last 20 years how many times it has increased from 2,000 to 16,000. It's like 8 times. It's like 8 times increase in less than, in around 20 years, in 21 years. That's a phenomenal kind of growth, right? Phenomenal kind of growth. Even today, if you do not want to do anything, if you have a slightly long-term avenues, the best way to do it is every month invest some amount of money in Nifty Bs, and any broker kind of allows you, like buying any other stock, you can keep on buying and then keep on, you take a small amount of your money, maybe 1,000 rupees, 2,000 rupees, 5,000 rupees, whatever is that, and constantly keep investing in that. Have a long-term view, at least 3 years at the minimum. At the minimum 3 years, because we know that today if Nifty is at 15,500 or 700 points, in 3 years we know that Nifty is definitely going to go up. In 5 years even more, in 10 years even more, right? Whatever happens to the market happens to your equity exchange traded funds as well. However, the risk is if the market goes down, these also go down. So that is the risk which you have to be willing to take. So that is exchange traded fund, which is highly traded and very popular as well. So you should definitely explore that. The next in line is which is pretty commonly done is chit fund. Now these chit funds are highly risky, highly risky, but still it has been reasonably popular amongst people because of the liquidity what it provides. Get into chit fund only and only if it is completely registered, recognized, and run in a professional way. Otherwise, do not even bother about getting in there with the private players. Otherwise, if it is completely recognized, registered, and monitored well, and the results are published on a monthly basis or quarterly basis, then it's kind of reasonably safe. The returns are very high in chit funds, compared to any other ones, but it also comes with similar amount of risks, right? That is the next one. And the last one is of course my favorite, which is the equity shares. You can invest in equity shares, understand various companies, and kind of invest in that. So we will go very deep into the last category, which is the equity share, in the subsequent section of how to invest in equity share. Hope you kind of so far understood the various categories, and then kind of having some thoughts and ideas of where you could kind of deploy your money. So if you're kind of getting the instruments to invest in, type in the comment, getting the instruments, and I'll see you in the next video where we will talk about why should you be investing. Until then, enjoy your learning. See you. Bye-bye.